All right, today we are jumping straight in to decode one of the most talked about patterns in trading, the fair value gap, or FVG, from the Inner Circle Trader strategy. We're going to break down the rules, the things you have to look out for, and the whole philosophy behind it, all based on the source material. So here's how we're going to do it. First, we'll tackle the big question that everyone has about these gaps. Then, we'll get into the nitty-gritty of what a fair value gap actually is. From there, we'll cover the rules for trading it, how to spot the ones that are just traps, and then we'll walk through a live trade to see it all click. And finally, we'll touch on the big idea behind this whole approach. Okay, so let's get right to it. Let's start with the one problem that seems to trip up almost everyone when they first come across this idea. You know what I'm talking about, right? You pull up a chart and these things look like they're everywhere. It's just a sea of potential setups. So the real question, the critical question, is how in the world do you separate the signal from the noise? How do you find the one that's worth your money? Well, that's what we're here to figure out. To even begin to answer that, we've got to get the foundation right. We need to know exactly what we're looking for. So let's break down the anatomy of a fair value gap, or as you'll hear it called, an FVG. At its heart, a fair value gap is really just a simple three-candle pattern. It points to a spot where price moved so fast, so aggressively, that it left behind an imbalance, an inefficiency. The dead giveaway is that there's a literal gap left between the wicks of the first and third candles. And here's how that structure plays out. You have candle number 1. Then comes the big one, candle number 2. That's the strong, impulsive move that creates the whole imbalance. And finally, candle number 3 comes along and confirms it. The key, the absolute non-negotiable part, is that the wick of candle 3 and the wick of candle 1 do not overlap. That space in the middle, that's your fair value gap. So, you can spot the pattern now. Great. But how do you actually trade it? Well, this methodology is all about precision. There are very specific rules for your entry, and just as important, for where you put your stop loss. Now check this out, because this is where it gets really specific. If you're looking to buy a bullish FVG, your entry is right at the low of that third candle. If you're selling a bearish one, it's the high. And you've got two choices for your stop. The aggressive stop goes just beyond the second candle, the big imbalance one. Or if you want to give it a little more room, the conservative stop goes just beyond the first candle of the whole pattern. And inside that gap, there's a level with a fancy name you need to know: consequent encroachment. All that means is the 50% level, the exact midpoint of the gap. This isn't just a random line. It's considered a super important reference point for what price is likely to do next. And this quote from the source material just hammers the point home. This isn't about drawing some fuzzy zone on your chart and hoping for the best. No, the whole idea is to trade off of very precise, very specific price levels that the pattern itself gives you. Okay, but here's the kicker. Knowing the perfect setup is only half the story, because not every fair value gap is a good one. In fact, according to this strategy, some of them are put there on purpose as traps, and you absolutely have to know how to tell the difference. And that brings us to something called the Judas swing. Think of it as a sharp, fake-out move, especially right around the market open. It's designed to look like the real deal, to get your heart pumping and trick you into chasing the move out of FOMO, right before it reverses. So, what does a trap FVG look like? Well, it usually shows up right after one of these Judas swings. And here's the giveaway. A real bearish FVG should form in the upper part of a down move. The trap? That one forms in the lower half. It's designed to scream easy money to anyone chasing the trend late. But the whole expectation is that price is going to rip right back through it and stop them all out. All right, that's a lot of theory. Let's see what this looks like in the real world. We're going to walk through a live trade, step by step, straight from the source material. Okay, so setting the scene is everything here. First, the time. The trade took place in what's called a macro, a specific time window that's considered really important. The setup was a clean bullish FVG, but here's the key. It formed after price dips down and took out the stops sitting below an old low. That's called a liquidity grab. And the target? It was another pool of liquidity waiting above a bunch of old highs. And look at the precision here. The trade went against the entry by only 1.75 handles. That's basically nothing. When traders talk about heat on a trade, this is what they mean, how much it goes against you. And to have this little heat, well, it tells you the entry was pretty much spot on. And it wasn't just precise, it was fast, incredibly fast. From the moment the trade was entered to the moment it hit the first target, it was all over in just 4 minutes. This is a huge part of the strategy. It's not about sitting and waiting for hours. It's about finding these quick surgical strikes. And the bottom line? On just a single contract, the trade pulled in $630. And that number really brings it all together, right? It's the tangible result of getting the context right, following the rules, and executing with precision. And well, you can feel the energy of the moment in this quote from the source video, right as the trade hits its target. So let's zoom all the way out for a second. This whole way of looking at the market, with its precise times and levels and patterns, it's all built on a pretty radical idea about how price actually moves. See, the core belief here is that the market isn't random. It's not just a chaotic mess of buying and selling. The idea is that there's an algorithm behind the scenes delivering price to specific places at specific times. And things like the fair value gap are basically the clues, the fingerprints that this algorithm leaves behind. And that really leaves us with the big question, doesn't it? When you look at a chart, are you seeing randomness? Or, as this whole strategy suggests, are you actually just learning how to read a script that was written long before you even sat down?